Okay, everyone's seated, so why don't we're a couple minutes early, but we'll give us some more time on the back end. So welcome, everyone, to the Stanford Institute for Economic Policy Research. Thank you all so much for being here. I'm Mark Duggan, the Trioni Director of SIEPR and the Wayne and Jody Cooperman Professor of Economics here at Stanford. All of us at SIEPR are truly honored to have Janet Yellen, the Chair of the Federal Reserve's Board of Governors, with us today. SIEPR's mission at Stanford is to support research that informs economic policy making while engaging future leaders and scholars. We aim to share knowledge and build relationships among academics, policymakers, the business community, and the public. Having the chair of the Federal Reserve spend time with us and share her insights is really in perfect keeping with that mission, and we are so very grateful that you are here today. A new presidential administration begins tomorrow, and the federal government will be filled with a new set of goals, priorities, and policymakers. But the economic challenges and opportunities facing the country won't change overnight, and the Federal Reserve is meant to be a source of stability. The Fed has several key functions, which include conducting the nation's monetary policy, promoting the stability of the financial system, supervising and regulating financial institutions, fostering payment and settlement system safety and efficiency, and promoting consumer protection and community development. Janet Yellen has been spearheading these efforts since 2014, when she was appointed to a 4-year term as the chair of the Federal Reserve's Board of Governors. She has brought with her a deep academic background in monetary policy, and she represents the strong and important connection between academic scholarship and economic policy, which really is our focus here at SIEPR. Dr. Yellen joined the faculty of UC Berkeley in 1980, where she is now Professor Emeritus and was the Eugene E. and Catherine M. Trefethen Professor of Business. She took leave from Berkeley for 5 years, starting in 1994, and served as a member of the Fed's Board of Governors through 1997, and then left the Fed to head the Council of Economic Advisors through August of 1999. She's also chaired the Economic Policy Committee of the OECD from 1997 to 99, and served as the chief of the Federal Reserve Bank of San Francisco for 6 years, starting in 2004, and returned to the Fed's Board of Governors in 2010 as vice chair. Dr. Yellen graduated summa cum laude from Brown University with a degree in economics in 1967 and received her PhD from Yale in 1971. It was while she was a teaching assistant at Yale when she first met a new first-year student named John Chauvin, our great friend, fantastic scholar, and my predecessor as the Trioni Director of SIEPR. Dr. Yellen went on to receive the Wilbur Cross Medal from Yale in 1997, an honorary Doctor of Laws from Brown in 1998, and an honorary Doctor of Humane Letters from Bard College in 2000. She's also been on the faculty at Harvard University and at the London School of Economics, and served as an economist early in her career at the Fed's Board of Governors from 1977 to 1978. Throughout her career, she has written on a very wide variety of macroeconomic issues while specializing on the causes, mechanisms, and implications of unemployment. Dr. Yellen is a member of the Council on Foreign Relations and the American Academy of Arts and Sciences. She served as president of the Western Economic Association, vice president of the American Economic Association, and a fellow of the Yale Corporation. I could probably spend the entire hour reciting all of the accomplishments that she's had, but I've tried to sample just a few of the most impressive, and there are many, many, many of them. So again, all of us here at SIEPR are so honored and truly delighted to have Chair Yellen you here with us today. Please join me in welcoming her, and please hold any questions until the Q&A segment after she has completed her remarks.
Thank you so much, Mark. It's a privilege to be here today to discuss how the Federal Reserve is conducting monetary policy to promote a healthy economy. For more than 30 years, research from the Stanford Institute for Economic Policy Research has informed economic policy, and events such as this one have helped foster debate among scholars, policymakers, business leaders, and members of the public on critical economic issues facing our nation. I appreciate the opportunity to participate. In my remarks today, I will review the considerable progress the economy has made toward the attainment of the two objectives that the Congress has assigned to the Federal Reserve: maximum employment and price stability. The upshot is that labor utilization is close to its estimated longer-run normal level, and we're closing in on our 2% inflation objective. I will then discuss the prospects for adjusting monetary policy in the manner needed to sustain a strong job market while maintaining low and stable inflation. Determining how best to adjust the federal funds rate over time to achieve these objectives will not be easy. For that reason, in the balance of my remarks, I will discuss some considerations that will help inform our decisions, including the guidance provided by simple policy rules. I will conclude by touching on some key uncertainties affecting the outlook. My assessment of progress to date will begin with the labor market. Since the depths of the Great Recession, about 15.5 million jobs have been added to the U.S. economy on net. In 2016, job gains averaged about 180,000 per month, well above the pace of 75,000 to 125,000 per month that is probably consistent with keeping the unemployment rate stable over the longer run. The unemployment rate is now close to estimates of its longer-run normal level, and other measures of labor utilization have improved appreciably. As shown in Figure 1, a broader measure of labor underutilization, the U6 measure, which includes not only the unemployed, but also people working part-time who would like to work full-time, and those who would like a job but are not actively looking, has retraced nearly all of the steep run-up that occurred as a result of the recession. Other indicators also support the view that the labor market has largely recovered from the severe downturn that occurred in the wake of the financial crisis. As illustrated by the red dashed line in Figure 2, the quits rate, an indicator of workers' confidence about leaving an existing job to pursue new opportunities, is nearly back to its pre-recession level. And some indicators, such as small businesses' assessments of the difficulty of hiring, shown by the solid black line, as well as the average length of time it takes firms to fill vacancies and the job openings rate, even suggest that the labor market is a bit tighter than before the financial crisis. Of course, both the labor force participation rate and the employment to population ratio are still much lower than they were a decade ago. But the cyclical element in these declines looks to have largely disappeared, and what is left seems to mostly reflect the aging of the population and other secular trends. Based on this array of labor market indicators, I judge labor utilization to be reasonably close to its normal longer-run level, while also recognizing that estimates of the sustainable levels of the unemployment rate and the employment to population ratio are inherently imprecise. In the coming months, I expect some further strengthening in labor market conditions as the economy continues to expand at a moderate pace, a view that is shared by most of my colleagues on the Federal Open Market Committee. Overall economic growth has been driven by consumer spending, which has been bolstered by substantial gains in household income and wealth. Business investment, in contrast, has been soft, but recent readings on business sentiment and new orders for equipment are consistent with the view that capital spending will likely strengthen modestly this year. Another positive factor is that oil drilling, which plummeted after oil prices fell sharply back in late 2014, has recently begun to pick up. As we look to broader trends, gross domestic product, GDP growth, has been restrained in recent years by a variety of forces depressing both supply and demand, including slow labor force and productivity growth, weak growth abroad, and lingering headwinds from the financial crisis. Although I'm cautiously optimistic that some of these forces will abate over time, I anticipate that they will continue to restrain overall growth over the medium term, likely holding down the level of interest rates consistent with stable labor market conditions. Turning to inflation, we're now much closer to the FOMC's 2% objective than we were just a year ago. Prices, as measured by the Index for Personal Consumption Expenditures, or PCE, rose nearly 1.5% in the 12 months ending in November, as compared with only 0.5% during 2015. Moreover, core PCE inflation, a better indicator of the underlying inflation trend, picked up a 0.25 percentage point to a little over 1.5%. This rise in inflation was anticipated and largely represents a fading of the effects of earlier declines in energy prices and the prices of non-energy imports. In addition, slack in labor and product markets is no longer placing downward pressure on inflation, in contrast to the situation only a few years ago when the unemployment rate was still quite elevated. Barring future major swings in oil prices and the foreign exchange value of the dollar, inflation is likely to move up to 2% over the next couple of years, aided by a strong labor market. In light of the progress that has been achieved toward our employment and inflation objectives and the committee's assessment of the outlook, the FOMC raised the target range for the federal funds rate at its December meeting by 25 basis points to between 50 and 75 basis points. The committee judges, however, that the stance of monetary policy remains modestly accommodative, and so policy should support some further strengthening in labor market conditions, and thus the return of inflation to our 2% goal. With the unemployment rate near its longer-run normal level and likely to move a bit lower this year, a natural question is whether monetary policy has fallen behind the curve. The short answer, I believe, is no. It is true that many employers report difficulty in finding qualified workers in selected occupations, and that more workers are comfortable quitting jobs to take or look for better positions. But this is to be expected in a healthy labor market and not evidence that the economy as a whole is experiencing a serious worker shortage. The recent behavior of wages provides additional evidence pertaining to the degree of labor market slack. As shown in Figure 3, increases in average hourly earnings, the employment cost index, and compensation per hour remained subdued, picking up only modestly of late. Again, these data do not seem consistent with an overheated labor market. Moreover, signs of overheating in the broader economy are also scarce. For example, capacity utilization in the manufacturing sector is well below its historical average. Most importantly, although core inflation is rising gradually from a low level, this increase mainly reflects the waning of the effects of earlier movements in the dollar, not upward pressure from resource utilization. Of course, even if the labor market is not overheated currently, one might worry that overheating could rapidly emerge as labor market conditions strengthen further, causing inflation to surge. I consider this unlikely for several reasons. First, the pace of labor market improvement has slowed appreciably in the past couple of years. For example, average payroll gains moderated from $250,000 per month in 2014 to $180,000 last year, and the unemployment rate declined 1.75 percentage points cumulatively over 2014 and 2015, compared with only 1/4 percentage point last year. Second, economic growth more broadly seems unlikely to pick up markedly in the near term, given the ongoing restraint from weak foreign demand and other factors that I mentioned, particularly in an environment in which monetary policy is likely to become gradually less accommodative. Finally, Figure 4 illustrates the relationship over the past several decades between labor market pressures and core inflation. Note that during the periods when the unemployment rate fell below the Congressional Budget Office's estimate of its normal long-run level, shown by the yellow shaded regions, core inflation, the solid red line, rose little if at all. This stability is especially marked since inflation expectations became anchored during the mid to late 1990s. That said, I think that allowing the economy to run markedly and persistently hot would be risky and unwise. Waiting too long to remove accommodation could cause inflation expectations to begin ratcheting up, driving actual inflation higher and making it harder to control. The combination of persistently low interest rates and strong labor market conditions could lead to undesirable increases in leverage and other financial imbalances, although such risks would likely take time to emerge. Finally, waiting too long to tighten policy could require the FOMC to eventually raise interest rates rapidly, which could risk disrupting financial markets and pushing the economy into recession. For these reasons, I consider it prudent to adjust the stance of monetary policy gradually over time, a strategy that should improve the prospects that the economy will achieve sustainable growth with the labor market operating at full employment and inflation running at about 2%. Achieving these goals could prove challenging, however, even if the economy manages to avoid being hit with adverse shocks over the next few years. To sustain its strong job market with inflation at our 2% objective, policy must gradually shift toward a neutral stance, where neutral is defined as a level of the federal funds rate that is neither expansionary nor contractionary when the economy is operating near its potential. But what level of the federal funds rate is neutral at the present time? How quickly should the funds rate target move up to this neutral level? And how will the neutral rate itself evolve over time? To help answer such questions, the FOMC considers a voluminous amount of information concerning many factors, including financial markets and credit availability, labor market conditions and overall economic activity, wages and prices, and foreign economic developments. The FOMC also evaluates forecasts from a range of economic models, assessments of key risks to the outlook, and detailed analyses of how different monetary policy strategies would affect projected outcomes and risks. Among the strategies routinely considered by the committee are the recommendations of a variety of simple monetary policy rules. In addition, FOMC participants prepare individual projections on a quarterly basis of the most likely paths of key macroeconomic variables under their own assessments of appropriate monetary policy, together with their estimates of the normal longer-run values of the federal funds rate, the unemployment rate, and GDP growth. Armed with this wealth of information, the committee as a whole then decides on the most appropriate policy action to adopt at each of its meetings. Such a comprehensive, forward-looking approach to policymaking is similar to that employed at other central banks. Figure 5 shows a plot of FOMC participants' most recent assessments of the appropriate path for the federal funds rate through 2019. The black solid lines show the median value of the federal funds rate at the end of each year. To understand the considerations that likely underlay these judgments, I will contrast participants' assessments with the recommendations of some simple policy rules commonly used to help gauge the appropriate stance of policy. As I noted, the committee routinely reviews policy recommendations from a variety of benchmark rules, and I believe that their prescriptions can be helpful in providing broad guidance about how the federal funds rate should be adjusted over time in response to movements in real activity and inflation. That said, I will emphasize that the use and interpretation of such prescriptions require careful judgments about both the measurement of the inputs to these rules and the implications of the many considerations the rules do not take into account. Consider first the well-known Taylor rule, which embodies key principles of good monetary policy. The rule calls for systematic adjustments in the federal funds rate relative to its expected longer-run neutral level in response to movements in inflation and the output gap, defined as the percentage difference between actual output and the economy's productive potential. To implement the rule, one must decide on the appropriate definition and measurement of its inputs. Should inflation be defined using the latest noisy quarterly reading on headline PCE inflation, or a measure intended to smooth through transitory price movements? What technique should be used to approximate the output gap, given that different approaches often yield materially different estimates? And what assumption should be made about the neutral value of the federal funds rate in the longer run? The Taylor rule is often implemented by assuming that the real or inflation-adjusted value of the longer-run neutral interest rate, which I will call R star for convenience, is equal to 2%, roughly the average historical value of the real federal funds rate prior to the financial crisis. For inflation, we can use the 12-month change in core PCE prices, a measure of the current underlying rate of inflation, and the output gap can be reasonably approximated as twice the difference between the estimated longer-run normal rate of unemployment and the actual unemployment rate. The dashed red line in Figure 5 shows the resulting recommendations for policy over the medium term based on the medians of the unemployment and inflation projections submitted by FOMC participants in December, but assuming, in contrast to the median of participants' December assessments, that R star equals 2%. As Figure 5 shows, this version of the Taylor rule prescribes a much higher path for the federal funds rate than the median of participants' assessments of appropriate policy. One important factor explaining this divergence is the FOMC's growing recognition that the longer-run neutral level of the real federal funds rate has likely declined below 2%, contrary to what is often assumed in implementations of the Taylor rule. As illustrated by the left-hand panel of Figure 6, since 2000, both FOMC participants and respondents to the Blue Chip survey have markedly reduced their projections of the level of real short-term interest rates expected to prevail in the longer run. Presumably, these revisions were made in response to accumulating evidence that lower real interest rates than those seen on average in the past would be needed permanently to keep the economy operating on an even keel. In addition, the right-hand panel shows considerable changes over time in estimates of the normal, longer run rate of unemployment, with corresponding implications for estimates of the economy's productive potential and the output gap. Such revisions would imply shifts in the level of the Taylor rule's prescriptions by as much as 1.25 percentage points, holding other factors constant. Clearly, sensible implementation of policy rules requires adjustments to take such changes into account, as a failure to do so would result in poor monetary policy decisions and poor economic outcomes. Figure 7 illustrates the policy implications of alternative revised assessments of the longer-run neutral real rate of interest. As before, the short dashed red line shows the prescriptions of the Taylor rule using the standard 2% assumption for R star. The solid red line, however, shows the rule's prescriptions with R star equal to 1%, the median of the longer run projections of the real federal funds rate made by FOMC participants last month. This adjustment appreciably reduces the rule's policy prescriptions. Even with this downward adjustment of the longer run neutral rate, however, the Taylor rule's prescriptions are arguably still too restrictive. The problem is that the rule ignores the likelihood that it will likely take many years before the forces now restraining the economy dissipate to the degree envisioned in participants' estimates of the longer-run normal level of the real federal funds rate. Because overall growth has been quite moderate over the past few years, despite an accommodative stance of monetary policy, some recent estimates of the current value of the neutral real federal funds rate stand close to zero. If the neutral rate were to remain quite low over the medium term, as would be expected if the global economy does not materially strengthen and productivity growth remains anemic, then the appropriate setting for R star in the Taylor rule would arguably be zero, yielding a yet lower path for the federal funds rate, as shown by the long dashed red line. These considerations illustrate that there is now no obvious right setting for R star because we do not know how rapidly the forces restraining the economy will abate, and there is significant risk that it could be very slow. When the economy has been hit with unusually persistent shocks, the Taylor rule, for this reason, provides a problematic benchmark. Simple policy rules also typically neglect information with potentially important implications for the economic outlook because they focus only on where conditions are today. For example, simple rules ignore such important factors as fiscal policy, trends affecting global growth, structural developments influencing the supply of credit, and overall financial conditions. One special factor at the moment pertains to the Federal Reserve's balance sheet. The downward pressure on longer-term interest rates that the Fed's asset holdings exert is expected to diminish over time, a development that amounts to a passive removal of monetary policy accommodation. Other things being equal, this factor argues for a more gradual approach to raising short-term rates. Lastly, simple rules ignore important risk management considerations that have influenced the committee's decisions in recent years. With the federal funds rate still near zero, the committee recognizes that should the economy unexpectedly weaken in the next year or two, there would likely be only limited scope to respond by lowering short-term rates. But if the economy instead began to overheat, threatening to push inflation to an undesirably high level, the FOMC would have ample scope to respond through tighter monetary policy. Such asymmetric risks arguably call for a more gradual path of rate increases than indicated by the prescriptions of a simple policy rule. The academic literature on policy rules has studied many alternatives to the Taylor rule, and the FOMC regularly reviews a number of them. These rules embed differing but valuable perspectives, and there is no consensus among central bankers or academics about the relative utility of various rules. One alternative is the balanced approach rule, illustrated by the purple short dashed line in Figure 8. This rule differs from the Taylor rule by being twice as responsive to movements in resource utilization. The prescriptions of the balanced approach rule in this figure, as with the solid red Taylor rule plot, assume that R star equals 1%, consistent with the medians of the latest FOMC projections. Because participants on average anticipate a modest undershooting of the unemployment rate below its estimated longer run level, the balanced approach rule calls for a slightly faster pace of tightening over the next several years than the Taylor rule. Figure 8 also reports results for a change rule, shown as the green long dashed line. As its name implies, this rule does not prescribe a particular level of the federal funds rate at a given time, but rather how the existing rate should change from quarter to quarter based on two gaps: the difference between inflation and its desired level, as well as the difference between the unemployment rate and its longer run normal level. In contrast to the other two rules, the change rule does not take a stand on the value of the longer run neutral level of the real federal funds rate, thus avoiding a potential source of error. Instead, it moves interest rates up and down until both gaps close, an approach that in theory enables it to perform well when the true value of R star is unknown. Because both gaps are relatively modest at the moment and are projected to remain so, the change rule calls for fairly gradual adjustments in the stance of monetary policy over the next few years given the current outlook. The FOMC, for reasons that I've discussed, does not base its decisions on the prescriptions of any specific policy rule. Nevertheless, the three benchmarks that I've described, the Taylor rule, the balanced approach rule, and the change rule, appropriately calibrated, have historically provided useful guidance about appropriate adjustments in the general direction of monetary policy over time. This guidance is illustrated by Figure 9, which compares the path of the federal funds rate since 2000 with the prescriptions of the three rules based on the actual rates of inflation and unemployment observed at each point in time, along with contemporaneous blue chip projections of the longer run unemployment rate and R star. As the figure shows, the rules clearly signaled that a major reduction in the federal funds rate was appropriate in 2008, given the marked deterioration in economic conditions. In addition, all three rules signaled that monetary policy needed to provide more stimulus during the recession and the subsequent recovery than could be provided by keeping short-term interest rates near zero. For this reason, the committee turned to asset purchases to help make up for the shortfall by putting additional downward pressure on longer-term interest rates. The FOMC also sought to compensate for its inability to push the federal funds rate below zero by indicating that the funds rate would need to stay unusually low for longer than otherwise would be expected and simple policy rules would prescribe. Under this makeup strategy, and taking into account the reasons for deviating from the Taylor rule that I discussed a moment ago, the committee kept the federal funds rate near zero for longer than two of the rules would have prescribed. But as labor market conditions continue to improve over time, the rising trajectories for the federal funds rate prescribed by all three rules signaled that the time was drawing near to begin gradually reducing monetary accommodation. Consistent with this advice, the FOMC suspended its asset purchase program in mid-2014 and began raising the federal funds rate in late 2015. So to sum up, simple policy rules can serve as useful benchmarks to help assess how monetary policy should be adjusted over time. However, their prescriptions must be interpreted carefully, both because estimates of some of their key inputs can vary significantly, and because the rules often do not take into account important considerations and information pertaining to the outlook. For these reasons, the rules should not be followed mechanically, since doing so could have adverse consequences for the economy. Well, my remarks have focused on the policy trajectory that the committee now considers likely to be appropriate to sustain the economic expansion while keeping inflation close to our 2% goal. In concluding, it's important to emphasize the considerable uncertainty that attaches to such assessments and the need to constantly update them. In particular, the path of the neutral federal funds rate, which plays an important role in determining the appropriate policy path, is highly uncertain. For example, productivity growth is a key determinant of the neutral rate. And while most forecasters expect productivity growth to pick up from its recent unusually slow pace, the timing of such a pickup is highly uncertain. Indeed, there's little consensus among researchers about the causes of the recent slowdown in productivity growth that has occurred both at home and abroad. The strength of global growth will also have an important bearing on the neutral rate through both trade and financial channels. And here, too, the scope for surprises is considerable. Finally, I would mention the potential for changes in fiscal policy to affect the economic outlook and the appropriate policy path. At this point, however, the size, timing, and composition of such changes remain uncertain. However, as this discussion highlights, the course of monetary policy over the next few years will depend on many different factors, of which fiscal policy is just one. Thank you very much.
So we have many experts in the room who I'm guessing are going to lob a question or two your way, but I'm going to ask just two.
Okay.
So here, you're sort of back in your, to some extent, your old stomping grounds, being in the Bay Area. And as you know, here in Silicon Valley, there's quite a lot of excitement about big data and how that can be harnessed to make various things better, whether it's business decisions better or people's lives better, perhaps policy better. So one thing that I'm curious about is whether and to what extent innovations on that front in the availability of data, the speed with which it's released, what have you, have enabled the Fed to do even better than it did, has increased the productivity of the Fed relative to 2, 5, 10, 20 years ago.
Well, we're very excited by innovations in big data and the potential that they have to enable us to make better monetary policy. And we're very involved in working on various projects connected to big data. But I do have to say that at this point, while we're excited and we see a lot of promise, the impact on monetary policy decision-making at this stage remains limited. And let me try to explain, if I could, the reasons for that. The data that we use in modeling macroeconomics, the US economy, we rely very heavily on statistical series that are produced by our main US statistical agencies, Census, the Bureau of Labor Statistics, Bureau of Economic Analysis. And there are good reasons for that. First of all, these agencies were organized and set up to focus on data to meet the needs of the Fed and other users. That is their goal. That is their sole focus. The data that they produce, they make available in a timely way. They try to ensure consistency and standardization over long periods of time. In estimating time series relationships, it's often important to have data that's been produced on a methodologically consistent basis and where we have a long data series. The statistical agencies have used theory heavily to decide how to go about measuring. I believe pretty strongly that good measurement does require underlying theory. So, for example, the price indices that are produced rely very heavily on theory, cost of living, underlying theory, and methodological improvements have been driven by that theory. The national income account data that we rely on, Simon Kuznets won a Nobel Prize for developing the framework that underlies it. And the statistical agencies are also focused on representative samples of information that adequately cover the US economy. And, for these reasons, the data that the statistical agencies provide has been very helpful in what we primarily rely on. Now, compare that with what's available in terms of big data, which, as I say, we're excited about and want to find ways to use. But often the firms that produce this data, their primary focus, their business focus is elsewhere, and the data that becomes available is a byproduct of work that they're doing. Often these firms will have some champion within it who sees the potential for data to be usable by the Fed or other outsiders. But importantly, often the core focus of those firms is something else and not the data. And so often we really can't count on that to be available. Often it's not representative, and users of big data often try to benchmark it to representative samples. Often the data is not produced taking theory into account and designed to meet the needs of users who are trying to really understand the US economy. And the time samples often are really quite short. So for us, we need to know how a particular series, for example, would behave during a deep recession, and having a few years of data doesn't allow us to do that type of modeling. So I think there are reasons why we continue to rely on traditional data, and big data hasn't yet transformed what we do. But let me say there is a lot of promise there because, first of all, the statistical agencies themselves recognize that there are gaps in their production of statistics, and they are looking to big data to try to improve what they do, and that's a very important initiative, and we're working closely with the statistical agencies to support their efforts there. Second, I would say that there have been some very interesting papers that have been done that do shed light on important macro phenomena that leverage the advantages that big data have, often a huge amount of detail. And in situations where, say, geographical detail at a very fine level is useful, where it's important to have a lot of detail about spending, for example, to be able to distinguish between spending at a grocery store and spending at a restaurant. Big data has been very useful, and I could give you a couple examples. Some Fed researchers were trying to understand the impact of the recent Hurricane Matthew on spending, and they relied on credit card data using that kind of cross-sectional detail to ferret that out. And there's been a pretty recent NBER working paper in which a group of academic researchers relied on a huge data set to try to estimate the marginal propensity to consume out of lower gasoline prices. And they leveraged features of the data to essentially be able to pin that at one. So it has been useful. I hope it will be useful in the future, but there are some problems with it.
Okay, good. My second and only other question for you is, I have many, but I wanted others here to get a chance, has to do with demographics. So you alluded to this a bit when talking about the labor force participation rate having fallen in recent years. And if we look forward, the projections from census indicate that we're going to see about a 70% increase in the number of people 65 and up, and less than a 10% increase in the number of non-elderly adults. And I'm sort of curious to hear your thoughts on what impact that will have on the economy and whether there are policy things that can be done to cushion any effects.
Well, I think you've identified one of the most important trends that's going to be affecting the U.S., and the same is true in many other advanced, developed and some developing countries as well, and it's already having clear impacts on the U.S. economy. Just to name a few, it's driving down the labor force participation rate. The labor force participation rate in the U.S. peaked at around 67% around the turn of the millennium, and it's now declined to the range of 62 or 63%, and it's going to keep declining over time. So it's certainly, that's an important factor shaping the economic outlook. It's driving down the growth of the labor force, and it's pushing down the pace of sustainable growth in the economy. My colleagues estimate their estimate of the longer run normal growth rate of the economy at this point is slightly under 2%. And that's an important factor that's governing that. What can be done? I think it pushes you in the direction of thinking about policies that would enhance productivity growth, enable the economy to grow more rapidly. Obviously, in terms of growth in different sectors of the economy, it's also very important in enabling one to pretty confidently predict that healthcare will be a sector of the economy that continues to expand. And of course, from a fiscal standpoint, it has very important implications. And just looking at CBO, for example, longer run projections of fiscal deficits, we have known for a very long time that with unchanged tax and spending policies, we're heading toward unsustainable deficits and growth in the debt to GDP ratio, because there will be large increases in the share of GDP devoted to Medicare, Medicaid, and Social Security.
Great. All right. So with that, I'm going to open it up to questions, and I don't know how exactly this is going to go, but let's see questions from our audience right here. Robert.
Thank you. First, thank you very much for your both long-dated service and for your leadership over the last few years.
Thank you so much. Appreciate
You
that.
started your speech, I believe, talking about the two mandates that the Fed has, and some seem to have argued that there was a third mandate added recently. And some of the people in government are now talking about that the Fed should only have one mandate, specifically price stability. And I wanted to get your thoughts on that.
So for many years, there's been discussion, and many countries have, their central banks have only a price stability mandate. I support a dual mandate because I think the American people care very much about both inflation and unemployment, or the state of the labor market. I would say that most of the time, and this has certainly been true in recent times, there has been no conflict between pursuing our inflation and employment objectives. For the last almost 5 years, inflation has been running under 2%, and unemployment has been well above normal longer-run levels. And so the policies that we would pursue for the sake of one objective are identical to those we would pursue for the other objectives. So normally we don't face conflicts. When there are conflicts, then those conflicts have to be managed. I would say that a formulation like the Taylor Rule formulation, or the FOMC produced a statement of its longer run objectives. We indicated when the two objectives do come into conflict that we would follow a so-called balanced approach in attempting to manage those trade-offs. Namely, we would look at deviations in our ability to attain both objectives and try to balance those off, focusing on both. And the simple formulation of the Taylor Rule also incorporates that type of logic, that essentially policies should depend on the deviations of both unemployment and inflation from, or output from potential, and inflation from its longer run goal. And I would say that most central banks, even when they are given a primary goal of price stability, do pay attention to the state of the real economy and really take that into account. So I think this is something that has worked well. I don't see a reason to change it, but our objectives are dictated by Congress, and if Congress wanted to change it, of course they could. It's not something that I would recommend.
Okay, next question. Professor Taylor of the Taylor.
I really appreciate your being here, and it's a great informative talk. Particularly liked how you balanced and compared the Fed's strategy actions with some of these rules. And in a way, my first question is, that seems like it could be something that could be expanded into even to meeting some of the requests that Congress has had recently to have this kind of a presentation. So that's the first question. Is that something you think could be feasible? Second, figure 9 is still up. And it does show something besides the period more recent. It shows this period where the funds rate was, as people call it, too low for too long in 2003, 4, 5, about 3 percentage points too low, at least compared to the red dashed line. And I've argued, many of others argued, that was a problem and kind of maybe even the source of the search for yield and the excesses that were partly leading to the problems we had in the Great Recession. So do you think about that? And to some extent, could this kind of presentation, if it were done way back then, have helped policy be better?
So let me start with the first part of your question, which pertained to offering explanations of the type that I did today. So today I tried to provide some insight as to why the FOMCs, we do offer systematic range of projections to the public, and I've tried to explain reasons for deviations. And as I've said, we have for a very long time looked at the recommendations of a range of policy rules, and they have been one important influence on policy, although we've not followed any rules specifically. So I do think it's reasonable for members of Congress to ask, what is the logic behind your policy? What strategy are you following? If there are deviations, can you explain what the nature of those deviations are and how you're thinking about it? And in this case, of course, I focused on considerations particularly having to do with the neutral funds rate and other special features of the crisis. So since your original paper back, was it in 1993, I've felt that the type of approach that you have recommended is a very useful input into monetary policy, and it's always informed my own thinking. And I believe in a systematic monetary policy, and I think we ought to be able to explain what we're doing. We have tried to do that, and I think we've made strides in offering these projections and a systematic statement of our policy objectives in advancing a systematic approach. Now, Congress, the House of Representatives, has actually passed legislation that goes substantially further than what I just discussed or you asked for. And I am very opposed, and have on the record is saying I am very opposed to what's known as the FORM Act, which goes much further than anything that you just suggested, and I believe really interferes with the independence of monetary policy by insisting that the FOMC adopt a rule, and after every FOMC meeting, if we fail to set policy in accord with that reference rule, the GAO will come in and audit and review our most recent decisions. So I do believe strongly in the independence of monetary policy, where we are and should be accountable to Congress. Congress should be asking us about the logic of our policy. These are entirely reasonable questions. We owe the public an explanation for why we're setting policy as we are. But when we're talking about GAO policy audits potentially after every meeting, I think that that is essentially bringing short-term political influence into the determination of policy. And if you read the act, it goes very far in constraining what we would be able to do. So I'm opposed to that type of approach, but generally sympathetic to the recommendations of rules. Now, I guess in terms of the departures, there was a departure from the Taylor rule recommendation. I mean, when you look at the picture, you can see that. Is that responsible for the financial crisis? I guess I know that you've argued that you feel that that was an important influence. When I don't think there's a straightforward relationship between deviations in interest rates from what the rule would call for and the conditions that gave rise to the financial crisis. There was a buildup in leverage. There were many special factors having to do with the housing market. The housing market had been really on fire before the time that these deviations developed. There were many unsafe aspects about the behavior of the credit rating agencies and all the special factors that we know contributed to the problems in housing. And, probably bank supervision fell down on the job, and unsafe conditions had developed in the shadow banking sector. And I think all of that was very important. So there may have been some deviations, but to say that that was responsible for the financial crisis, I guess I wouldn't agree with that.
Okay, I don't know what I'm going to do here. Okay, you raised your hand before. John Cochran, yep.
John Cochran, good to see you again, Janet. I hope you're having a good time and you'll come back more often. You painted a picture of gently raising funds rate in an economy that's gently expanding, and I only wish you that is your job for the next couple of years. But with this discussion of the recent crisis and other events, I'd like to ask you, what keeps you up at night? At 2 in the morning, there's plenty of things you look around the world. China, God knows what's going on there. Southern Europe, state pensions. How can I put this politely? Some volatility in our trade relationships. And clearly, one of the big things the Fed will have to do is respond to something. Our expansion's getting pretty long. So what keeps you up at night, and what are you planning to do about it, to the extent?
Well, in our most recent statement, we described, the FOMC described the near-term risks as roughly balanced. And it's been a while since I felt that. I mean, if you go back over a number of years here, there have been a whole set of global risks relating to China, relating to Europe, relating to conditions in developing countries, in commodity markets, that have been very worrisome. Greece and other developments in the Euro area that have really kept us up at night. And some of those concerns have not disappeared. We spend a good deal of time monitoring what's happening in China, where growth is slowing, very important influence on the global economy, financial developments there that could be problematic, that we think the Chinese have the ability to deal with, but do create risks. So there are a set of global risks. As I've indicated, I think the U.S. economy is, at the moment, moving along at a pretty reasonable, decent pace. Obviously, there are risks, and there could be changes in policy that we will have to take account of. We don't yet know what those policy changes are going to be. I mean, I purposely ended my remarks by saying this is what I think is going to happen if I'm forced to write down. And what we do write down in these projections that we do are modal outlooks. What's the single most likely outcome? But uncertainty is prevalent, and policy could, as you say, end up behaving very differently than anything that I've described today. So I'm losing a little bit less sleep than I have for a number of years. I've served on the Fed. I mean, I feel the U.S. economy is in a reasonably good position, and there's a little bit less to lose sleep about now than there was certainly going back to 2008 and 9 and 10. But of course, you're right that there are many risks afflicting the outlook.
So there's something called the Chauvin rule, and I'm going to actually deviate from it here and allow one more question from my colleague, Professor Boskin. Finishing on time, we're going to go a couple minutes over, so I apologize.
Let me echo all the other warm greetings and appreciation for your service, and the hope that you'll be back here often in years ahead. You gave us a view of the economy and your outlook and so on. But one of the duties of the Fed for a long time, and increasingly with now macroprudential regulation and these agency-wide oversight things, et cetera, you have an increasing role on looking at the financial system more directly, and especially the banks, but more broadly. And we have now controversies over Dodd-Frank. I think probably all the economists in the room would support the higher capital standards, but much else in it's controversial. Let me not dwell on that, but would you care to give a summary of your view of the health of the financial system and the banking system?
Well, thanks for that question, because let me just say that one of the most important focuses of work at the board and throughout the Federal Reserve System in the aftermath of the crisis is financial stability more generally. Of course, we play an important role in the banking system in assessing that, but it is our objective to try to be alert to financial stability risks that may be emerging anywhere in the financial system. So, and I would say we have regular financial stability reports, and financial stability has become a regular topic of discussion even in the FOMC, because we recognize that interest rates in this macroeconomy can generate financial stability risks, particularly in a period when interest rates have been low for a long time. So we look at many different indicators, but let me just sum up by saying that I would describe financial stability risks at this point as being moderate. So not elevated, not zero, but moderate. So a couple of broad categories of things we look at would include leverage in the financial system. And I would say that leverage is not at a particularly high level relative to where it was prior to the financial crisis. The pace of credit growth, very rapid credit growth, can be another indicator of emerging financial stability risks, and we don't see that either. A third category, broad category of things we look at would have to do with asset valuations. And in some sense, asset valuations are high. I think that's partly a reflection of the fact that interest rates are low. So interest rates are one of several factors that affect asset valuations. Now, we talked today about the likely path of interest rates. There is an emerging view that not only are interest rates low now, but they may stay low over time because of this decline in neutral rates. Such expectations seem to be built into the structure of interest rates in the markets. And asset valuations are not at unusual levels relative to the level of interest rates. So price-earnings ratios in some sense are high, but rates of return on stock, or the equity premium, is at a pretty normal level. But the path of interest rates in the economy is uncertain, and there could be movements in asset valuations if in either direction is because of uncertainty about the level of interest rates. But broadly, I would characterize financial stability threats at this point as moderate, but we are always on the lookout for them, and this is an important change since the crisis.
Worried all about Europe's banks?
About
The risk from Europe's banks affecting our banks?
Europe's banks. So we've looked pretty carefully at exposure, but both at the European banking system, where there are some problems, but the spillovers don't look, even within Europe, to be very great, as well as the exposure of our banking system to the European banking system. And the exposure is not excessive.
So with that, I think we should wrap up. So please join me in thanking Chair Janet Yellen. Thanks so much again. That was great.